Welcome to this week's weekly Market Matters video. It's the 30th of September today, the last day of September, James. We're going to talk about that to kick things off. It's traditionally been weak and we've seen weakness play out on the ASX this month. What's your take on this pullback?
Yeah, September weakness followed by the Christmas rally is what traditionally happens. It doesn't happen every year, but it happens more often than not. To put the pullback in the context, this September we're down 6.4%. Last September, so September 2020, from the high to the low in that period, we dropped 7%. So, you sit here and go, we're probably in the realms of normality. Obviously, all pullbacks are unnerving when they happen, and then you get the obvious questions and queries and concerns that this is a start of something more sinister. I'm not seeing anything that at the moment that is overly alarming. The market's expensive, there's no doubt about that. You've got to be picking the right sectors to be in and some active management and aligning portfolios with what's happening from a macro standpoint is really key. But from an overall perspective, Harry, I don't think this is a pullback to be alarmed on at this stage. And we've been using as a buying. We're still pretty much fully invested across our portfolios. Yeah,
definitely. Sector weakness has played out across a few, but one that's been strong has been energy. Oil prices and the like have rallied pretty significantly, but that's also played into inflation fears. Do you see that being more of a long-term issue or medium-term issue, this inflation pressure?
Yeah, I guess there's two parts to that question, just around the energy prices and probably more of a there's some lessons there for the broader commodity complex and why we own specific commodities at this point in time. So, if you think a little bit more medium term to longer term, there's obviously a lot of the majors are starting to reduce their exposure to oil, energy, ESG concerns and the like. So obviously we're seeing less money being put in the ground, less chance of financing that at reasonable rates. So you get a situation where supply is going to be curtailed over the coming few years, over the foreseeable future, but demand is going to tick up. So that's a really supportive backdrop for prices. So I get the ESG thematic, I get the push forward and the huge movement to electrification, etc. But in the interim, there's a real case to remain bullish energy, oil, coal, and that's what sort of we've been playing at. And that's it's supply driven rather than demand driven at this point in time. So we remain really bullish the energy sector, and that's a key positioning for us going into the back end of this year. It will likely be in the 2022 as well.
Yeah, definitely. A bit more on that sector rotation playing out. IT and healthcare have been particularly weak. Two sectors that tend to perform poorly when bond yields are rising, but energy and resources strong. Is that cycle going to continue, or will we see these bond yields really press on IT and healthcare near term?
Yeah, I brushed over your question about inflation before. So, higher energy prices and commodity prices and food prices that we covered in this morning's note filtering into rising inflation. So, Jerome Powell, the Fed chair, overnight stressed their interpretation of what's happening from an inflationary standpoint, that they believe it is transitionary, not structural. I think that probably the middle ground is right. I think we are going to have rising inflation. We're going to have rising interest rates, rising bond yields, and that has an impact on what sectors that we should be invested in. And as you rightly point out, Harry, IT, healthcare, etc., those high value parts of the market are hurt by rising bond yields. We've written about it a lot. If Market Matters subscribers would know this like the back of their hand, that rising interest rates, bond yields are negative for long duration assets. Long duration assets are these things that are priced really highly now because they have really strong earnings growth in outer years. So that's a thematic that we're really conscious of. It doesn't mean we won't own healthcare stocks, and it doesn't mean we won't own technology stocks, but we'll be more selective and we'll be more overweight the value cyclical parts of the market, like the resources, like we are at the moment. Financials fit into that bill. Some industrials fit into that bill as well. So that's sort of how we think about that from a portfolio composition perspective.
Yeah, definitely. We made some changes to the portfolios this week, switched a bit out of Newcrest into a little bit more of IGO in the growth portfolio, made some changes to flick into APA Group in the income portfolio. Just a quick take on those moves there, James.
Yeah, so timing in Newcrest was probably not optimal, but we just trimmed that a little bit. We had a big overweight in Newcrest. We had 7% of the growth portfolio in Newcrest that was plumbing 52-week lows. Hasn't been a great one for us, so we trimmed that. Basically, we like IGO Independence Group, nickel, lithium more at this point in time. So we thought our 2% of capital from Newcrest was going to deliver a better return outcome for us in IGO. We wanted to increase that 3% weighting to 5%. So that's the rationale there. APA Group sort of goes against my comments just earlier around rising bond yields. It's a regulated infrastructure provider, gas pipelines and the like. They've got a lot of corporate activity going on at the moment. They're in the running to buy Basslink, which is a transmission asset. They're also launched a bid for AusNet Services, which is a poles and wires business. That's Brookfield's in there as well, and a bunch of other things. So, I mean, we bought that because we think the stock has been. There you go. There's China manufacturing. I'll turn that down. So, I mean, APA Group has been sold down in our view based on some corporate things. We spoke with the company this week. We're comfortable in the direction they're taking. We think the move to buy these assets, especially AusNet, is going to be a positive one. So we added that to the income portfolio. We've topped up Transurban through the rights issue. We think that makes sense. Bullish Transurban longer term. And in your portfolio, Harry, the emerging companies, we dipped our toe back into Paladin in the mid-70s. We sold it at 95, bought it back mid-70s. Uranium's going to be really volatile. We'll add to it if it goes lower. So if it pulled back to 60, we'll probably add to it, as you alluded to in the note you sent out on that one. So that pretty much wraps up our portfolio changes this week.
Yeah, definitely. Smart Group, they copped a bid this week, $10.35 a share. They're looking at from the private equity group TPG. Done well for us in the income portfolio, but it's still $1 below that bid there, James, today. Where would you see that one going?
Yeah, we've often written that we thought Smart Group was a pretty compelling buy. It had a really clean balance sheet, conservatively run business. They had some issues a couple of years ago, just in terms of struggling with revenue growth, etc. But it's always been a well-managed business, not overly expensive, pays a good yield. One of those businesses that continues to plod along. And TPG has obviously seen that. They've lobbed a bid. They're keen on it. It's obviously conditional and indicative at this stage. They're going to do some DD, but they've got exclusivity. It was up 18% yesterday. It's one of our largest holdings in the Market Matters Income SMA. It's got about 7% weighting pre-bid. So we like it, and I think it's even a good play. You think about the 10% upside of the bid price. I think it's even a good play to be buying it out. So China data coming out as we're recording this, as you can hear. So look, I continue to like it. We're going to hold it and see how this plays out for 10.35 or potentially another bidder, Harry.
Yeah, just quickly to wrap this up, James, we've got some pretty tight cash levels in both portfolios, but are there opportunities out there you've been looking at?
Yeah, there is. I mean, I actually like the composition of our portfolios at the moment. So if we obviously look at performance stats every day. We're looking at the portfolios every day, trying to optimize it. I look at the performance in the portfolios throughout September, which has been a weak month. One of the key considerations is that, or one of the keys that I like to keep a handle on is downside capture, how the portfolios perform in a weak market. That to me is a really key in thinking about or determining whether we're in the right parts of the market. And I think we are. I think the portfolios performed really well relative to a weak market in September. So overall, I'm really comfortable with our position. So I don't see, insect pivot. We wrote about this morning. We wrote about GrainCorp in the agricultural space. I like those. You've written about Audinate in your emerging companies portfolio. We like that into further weakness. So there's always opportunities out there. But at the moment, I look at the composition of our portfolios, and aside from what we saw yesterday with slightly overweight Newcrest, trimming that down and putting it in IGO, I'm pretty comfortable with the portfolio positioning at the moment. Always looking for opportunities, Harry, but pretty comfortable at the moment.
Yeah, definitely. Good to chat, James. Thanks for catching up.
See you, mate.